Can the stock market rally last? I'm Lisa Bernhard with Reuters, and I'm joined today by Ross Mayfield of Baird. Ross, the S&P 500 is up 9% since late October, 17% for the year. November and December are typically good months for stocks, but of course, we know we've got a lot going on, a lot of variables. Can the stock market rally last? What do you think?
I think it can last, but you need follow through from earnings in 2024, and you basically need a soft landing in the economy. So as you mentioned, seasonality and sentiment were big assets coming into November. The market was basically coiled like a spring to have a short-term rally if there was some reprieve on rates, and we got that. To have a follow through and have this rally broaden out and kind of turn into a more cyclical bull market or a continuation of the one that started earlier this year, you do need follow through from the economy and earnings. I think it's possible. I think it's maybe even likely, but earnings are expected to grow double digits next year. You still have higher for longer interest rates. So as you mentioned, a lot of variables. The rally can continue, but you need follow through from the actual economy to sustain what we see so far this month.
You mentioned earnings, and we saw a lot of retail earnings this week. Gap today, the stock's up huge. What's been the key to retail earnings? What have investors specifically been looking for?
I think two things. I mean, at a macro 30,000 foot level, investors really care about consumer earnings because the consumer has been the driver of the economy so far. And there's been this looming question for 12, 18, 24 months of when is the consumer going to run out of steam? I think for individual companies, it's one, how well positioned are they for a downshift in the consumer? So maybe not an outright recession, but a belt tightening, maybe moving down in quality or price. Which retailers are best set up for that type of scenario if the consumer tightens the belt into 2024? And then how are you managing your inventory? This has been an insane 2 years for inventory management. The consumer has shifted from goods to services and all across the board on big ticket. And now we're moving back down. So how companies have managed their inventory mix and what's on their shelves and how they've gotten them to their stores, supply chain management as well, has been really key to which companies are able to beat, which companies are able to guide better. And that's what investors have really been looking for.
And guidance has also been mixed from companies. Has this been sector specific, company specific, and what does it portend?
Yeah, it has. There's been a wide dispersion on the guidance. So for the fourth quarter, the consumer discretionary sector has been probably the weakest sector as far as guidance. So it falls right into line with that. Is the consumer weakening? It's why some of these big retailers have been overly punished on, maybe beats and guiding lower because there's this big looming question out there. So discretionary is in the crosswinds right now, and their guidance is proving it. But for the full year, discretionary has held up pretty well. Staples have held up pretty well. The two big standouts have been tech and industrials. Those are two of our favorite sectors. But the companies are guiding higher. There's optimism around different sub-industries within the sectors. And they're able to better withstand kind of a slowdown in the consumer as well.
How do higher for longer rates change the investing dynamic from the pre-pandemic days when we were at near zero rates?
Yeah, this is a tremendous question. I think it's the question that defines the next 5 to 10 years. No matter how many business cycles and recessions we go through, if we have this higher floor under interest rates and long-term interest rates, you're going to want to shift towards higher quality companies that are better able to self-fund, that have strong free cash flow growth, that aren't super reliant on tapping the debt markets every other year to fund their operations. The 2010s and the ZIRP era and the QE era allowed a lot of businesses that might not have otherwise been sustainable to survive and also to be stock market darlings at times. If there is a higher for longer era in interest rates and inflation, that is over, and the shift towards higher quality companies, pick your sector, pick your time of the business cycle, higher quality, better balance sheet management is going to be the thing that helps companies outperform. And maybe even having management that's been there before, not companies that were just founded in the last few years, but pre-GFC when rates were around where they are today. How did companies do then? Do they have the experience on the management team to survive?
You mentioned the consumer, all eyes on the consumer, and next week is Black Friday. Is this year's Black Friday going to be particularly scrutinized more than ever?
I think yes, it will be both Black Friday and the discounting that we see there, but also the holiday spending overall heading into the end of the year will be deeply scrutinized. Again, those consumer sectors have given pretty weak fourth quarter guidance overall. But I think the bigger question is not how does the consumer hold up into a holiday season where they'll probably spend, even if it's on credit or even if they're kind of scrounging at savings at that point. The question will be, how are consumers acting in Q1 of 2024? Because if the last gasp was the holiday season and then they really tighten the belt to start the next year, that's when you'll really start to see it in company earnings and guidance. If the consumer is in a better position than some might think, and if the labor market is actually the thing propelling the spending, then we wouldn't expect a big fall off in Q1 and Q2 of 2024. So I do think the holiday season is important to watch. What are companies doing on the discounting front in particular? But as far as consumer health, I think you're actually going to want to look out past the holiday season to get a better sense of what the consumer picture actually is.